Dear students, let us discuss the 16th session. In other words, it is the 6th session in security analysis, that is the second chapter. So here we are going to continue with the equity valuation models. So here I will take simple problems from dividend discount model, which is important from the point of view of your exam. Of course, many problems are there on each and every model, but we don't have it for us. So I will be dealing only with what is required from examination viewpoint. So let us go for equity valuation model, continuation of this. Recap of the previous class. So here we have equity valuation models. We have discussed various equity valuation models. Now this chapter aims to provide an overview of the securities analysis. After this session, you will be able to understand how to go for equity valuation models and how to use the formula in order to obtain certain concepts. So let us go for as I have told you in the previous slides, we have discussed equity valuation models. We have basically 4 models. The first one is earnings model, where we try to calculate the earnings of the organization. Second one, we have discussed about cash flow valuation, so wherein we try to ascertain the cash flows. Third one is we have done asset valuation, wherein we try to ascertain the value of the asset, that is stock, bonds or securities, whatever. The third one is dividend discount model. So the dividend discount model tells us that it is a procedure, we use it for valuing price of a stock. What we do here is we try to discount the dividend, future dividends at present. That is, we find out the NPV of the dividends and we try to ascertain the value of stock. So if the value obtained from dividend discount model is higher than what the shares are currently trading at, then the stock is said to be undervalued. So we have basic simple problems on this. How do you get value of stock? We have a formula: dividend per share divided by discount rate minus dividend growth rate. So this will be given in the problem. You have to only substitute, so you will get the answer. Let us go for problems, students. But as I told you, I will be working out very simple problems. So here we have, here the first problem, the expected dividend per share on the equity share of X Limited is ₹2. The dividend per share of X Limited has grown over the past 5 years at the rate of 5% per year. This growth rate will continue in future. Further, the market price of the equity share of X Limited 2 is expected to grow at the same rate. What is a fair estimate of the intrinsic value of the equity share of X Limited if the required rate is 15%? Actual rate is 5%, required rate is 15%. Okay, so what is the dividend we are going to get? We are getting to get ₹2, and the share, they have been getting the same value for past 5 years, and we want to know what is the stock value right now. So in this, what we do, we take dividend per share as it is specified in the question. We have ₹2 is the dividend per share, divided by discount rate. The discount rate what we expect is 15%, and what is the actual growth rate? The growth rate is 5%. So what we do, we take the dividend per share ₹2 divided by, it is actually taken in percent. 15 divided by 100 is 0.15 minus 5 divided by 100 0.05. So we have got 0.15 minus 0.05. So 2 divided by 0.15 minus 0.05 is 0.1. So 2 divided by 0.1 is ₹20. So the stock value or the value of stock now at present will be ₹20. So this is the answer what we have got. This is a very simple, easy calculation what we have. So you have nothing to worry about much, students. Let us go for the next question. So here we have question number 2. Ramesh Engineering Limited is expected to grow at the rate of 6% per annum. The dividend expected on Ramesh's equity share a year hence is ₹2. What price will you put on it if your required rate of return for this share is 14%? So here they have been getting rupees 2 per share as dividend, and the annual growth rate is 16%, sorry 6%, and the expected rate of return is 14%. So you might have understood how to substitute in the formula. So dividend per share is how much? 2 rupees. And what is the expected rate they have? 14%, that is 14 by 100, minus 6%, that is 6 by 100. So 2 divided by 0.14 minus 0.06. Okay, that is 0.08. 2 divided by 0.08, you will get rupees 25. That is the value of stock as per the discounted rate what we are going to consider. Okay students, this is once again a simple problem what you have. The next one is we have question number 3. The expected dividend per share on the equity share of Xavier Limited is rupees 3. The dividend per share has grown over the past 5 years at the rate of 6% per year. The market price of equity share is expected to grow at the same rate. What is a fair estimate of the intrinsic value of the equity share of Xavier Limited if the required rate is 16%? Here we have the similar problems. The rate of return dividend what we are getting is rupees 3, and the dividend per share, the growth rate is 6%, and we have the expected rate as 16%. So we take only these factors into consideration. So here we take 3 rupees divided by 0.16 is nothing but the expected rate minus 0.06. So you get 3 divided by 0.1. So the answer is how much? 30. Have you understood students? Be very careful. We have only 3 concepts here. One is dividend per share, what you are going to get. The second one is the discount rate, what you are expecting, and dividend growth rate, what is the actual rate which you are going to get. So that taking that into consideration, you will calculate the value of the stock. So here we have the next question. Suhas Engineer Limited is expected to grow at the rate of 8% per annum. The dividend expected on Ramesh equity, Suhas equity share a year hence is rupees 4. What price will you put on it if your required rate of return for this share is 17%? So here for us the return dividend what you are going to get is rupees 4. So the rate of growth is 8% and the expected return what we have is 17%. So here we will take into consideration the share value of on that particular date divided by 0.17, that is the expected rate, minus 0.08, that is the rate what the share will have, the growth rate. So that we will take into consideration and we will get the answer as 44.44. Okay students, these are very simple problems. Since we are dealing with the session for 2 sessions on equity valuation models, I have taken a simple problem and I have solved. Just go through this, you will understand it better. And now we will go for the multiple choice questions. So here total return is equal to capital gain plus price change, yield plus income, capital gain minus loss, yield plus price change. It is nothing but capital gain plus price change. So here we will get the answer as capital gain plus price change. The next one is the return component that gives periodic cash flows to the investor is known as the capital gain, the interest rate, the yield, the unrealized gain. So the return component will be considered as the yield what you are going to get. The next question is the expected return on an investment in stock is the expected dividend payments, the anticipated capital gains, the sum of expected dividends and capital gains less than the realized return. It is less than the realized return. The next one, Historically, PE ratios have tended to be higher than when inflation has been high, lower when inflation has been high, uncorrelated with inflation rates but correlated with other macroeconomic variables. Uncorrelated with any macroeconomic variables including inflation rates. It is actually lower when inflation has been high. So generally it is preferable to invest during non-inflation periods than during periods of inflation, so that you get a high rate of return. The next one is financial assets permits all of the following except consumption timing, allocation of risks, separation of ownership and control, elimination of risk. So financial assets permits all of the following except elimination of risk. So students, these are the objective type questions. We have the references for you, and just to go through the problems and go through the references. And as I have told in the previous chapter, we have spoken about risk and return. Their problems will be there for 6 marks, and here also very simple problems will be there. And in next chapter also you will be having some problems. Okay students, I'll see you in the next session. Thank you.